What's going on? What is going on, guys and gals? What a crazy, crazy week it's been over the last week. Crazier weekend. But lots going on, lots to unpack. So let's go ahead and jump right on into it. We're going to go over some technicals. We're going to go over the technical charts on the weekly, on the daily, and the 4 hour. Give you guys a breakdown of where the market's at, where we think it's going, why we think it's going that direction. Let's talk about Silicon Valley Bank, the bank collapses, and Signature Bank. We have economic data coming out this week. We had economic data come out last week. And so let's bring it all together and give you guys a sense of what's really happening, what we should expect, and how it all ties in together. So we're looking at the daily chart right here. Last week, we actually talked about a potential sell-off right after a key economic event or a key catalyst, not so much an economic event, which was Jerome Powell testifying on Tuesday and Wednesday. And that video came out right after we broke above this EMA here on the daily chart, and we ended up pushing up to new highs, I guess, of that week. It wasn't new highs of the trend, but from where we were at, because the week before that, we were actually in between this level and the EMA, which was between the 100 and 200-day simple moving average and between the exponential moving average. And that was a critical point for us to either break to the downside or break to the upside, which is what we ended up seeing. But that didn't last too long. And the reason it didn't last too long was because of Jerome Powell testifying. And what he said when he testified was that if the economic data is coming in hotter than expected, and if obviously all the economic data is pointing to the fact that they do need to raise rates, they won't hesitate to raise more rates or raise rates more aggressively. And so as soon as he said that, we saw exactly what we anticipated was going to happen. We broke below the EMA and started pushing down to newer lows. Then today, what we ended up seeing was we saw a little bit of a relief rally, but that was followed by or following two crazy days, Thursday and Friday, when we started seeing the Silicon Valley Bank starting to collapse and then eventually collapsing. And so we kind of want to touch on that whole situation and how that ties in with everything. So Silicon Valley Bank was not just an ordinary bank. It was the 16th largest bank in America, right? And 97% of those deposits were actually over 250K, which means that it was not insured by the FDIC, right? Obviously, that's not how it ended up playing out, but initially that's kind of what happened. And one of the biggest accounts was actually $3.3 billion, right? And that was just a single account. So if it's insured up to 250K, the rest of that money would not be insured and essentially wouldn't be returned to the depositor, right? And so what happened was the government ended up, in a sense, for a lack of better words, bailing out not the bank, but the depositors, right? So they created an emergency fund that would pay the depositors what the bank would not be able to pay. And kind of what happened with the Silicon Valley Bank was they ended up technically betting on the interest rates. They made $100 billion bet with the funds in the bank that interest rates would not continue to go high, right? Or higher. And when when interest rates started going higher, the banks obviously kind of were not able to be liquid enough to pay back their depositors. And when depositors got a whiff of this, they started running on the bank and asking for their money back. Obviously, the bank was not able to get them their money back. And so that's kind of what happened with Silicon Valley Bank. And that's kind of why it ended up dropping. Now more than ever, kind of the situation of every other bank is coming to light. And so in essence, that's kind of why we saw, the other bank, Signature Bank, fall as well, get shut down. And we don't know how many other banks have really bad exposure or really bad positions where they, in essence, are illiquid and are unable to fulfill the requests from their depositors when they come to get their money, right? So that's kind of the situation. And, you might think that, hey, okay, it blew over. The depositors got their money back. The government stepped in, the FDIC stepped in, they got the depositors their money back. It wasn't as bad as everybody makes it out to be. But the real deal here is the fact of when the FDIC said that they were going to ensure that the depositors got their money back and it would not come out of the taxpayers' dollar, where are they getting that money, right? And in essence, we're kind of going back to square one of what got us in the situation in the first place. What got us in the situation in the first place was us printing money. And if we're not going to be getting it out of the taxpayer, right, where's this money coming from? Which draws the conclusion that it probably is going to get printed again. And in essence, cause inflation to get worse, right? And so that's kind of the bigger picture here, the bigger problem. It's not that single bank, but it's what's happening outside of that bank, right? How is that bank, how does that emergency fund being created, right? Where's that money coming from? And that's the bigger issue. So that's kind of what's happening with the Silicon Valley Bank. If you guys haven't heard, I'm sure a lot of you have heard by now. And so that was in essence Thursday and Friday. Today, we ended up seeing a relief rally. The members on the team that I trade with every single day, they were expecting this relief rally. We talked about it on Sunday night with the team. We mentioned that we would probably see a little bit of a relief rally after seeing so much selling for a week, right? And if not even just a week, look back at the last 2-3 weeks, we've been seeing selling that entire time. So a relief rally was not, the worst thing to see, and it was definitely expected. So we are looking at the daily chart. Let's go ahead and jump into some technicals. After we do some technicals, we'll go over the key economic events that are happening this week, some economic data that has come in prior to this day today, and prior to the CPI report that's coming out tomorrow. We'll talk about the key economic data. We'll talk about the technicals. We'll tie it all in together. And that way you guys have a better idea of what to expect in the coming week, right? Leading up to next week, which is when we were supposed to see interest rate hikes. And the question is, are we going to see them or are we not going to see them? And I'll tell you how you would be able to know tomorrow, most likely, if we do end up seeing those or not. So looking at the technicals on the daily chart, we kind of broke down, what happened here. The key thing that I want you guys to notice is that we are not extremely oversold, right? We're not in this zone right yet. So that means we do have more downside potential to come back down even lower, right? We're sitting at approximately 45 right now, which is basically in the middle. 50 would be in the middle. We're sitting in the middle. So we can go either way without becoming very overbought or very oversold. And that's just looking at the daily chart. So I want you guys to note that we do have room to go to the downside without becoming super extremely oversold. So it would make sense if all the stars align and if things do end up getting worse and we get that confirmation, not only tomorrow, but also by the rate hikes that were supposed to happen on the 22nd and 23rd. And if they do happen, it would all add up. But let's go ahead and piece it all together. So RSI, plenty of room to keep going lower before we become oversold. And then looking at the MACD, we are not converging just yet. We were about to. That was last week. We were trying to converge. We got that catalyst that ended up pushing the market lower. And so we started a new leg to the downside, right? So we haven't changed color from red to orange. We are currently still in the red. We have plenty of room to run to the downside. And the biggest of all of these things I want you guys to know is that the price that we closed at today is below the 180-day, 200-day simple moving average. And that was a level that we actually struggled to break 2 weeks ago, right? And so if you guys notice, we had higher highs here lower highs. We had lows here and new lows right here just today. So if you guys can see, higher highs, high highs, high lows, lower highs, lower lows. And so that is in essence a staircase pattern for us to be able to be coming down to the downside. And so we obviously closed below the 180-day, 200-day simple moving average. We closed below this support. We closed below this 180-day, 200-day simple moving average, which is also the 50-day simple moving average. And we just have that 100-day simple moving average to break to the downside before we head down to potentially this 260, 262 level. And that would make sense because we have support here, we have support here, we have support here. So coming down would be very, very likely, especially if everything else aligns. So that is what we are looking at on the daily chart. Before we continue, I do want you guys to know that we are, as a team and as an academy, looking at a short position right now. We are actually in a short position right now. And this is kind of the technicals that are indicating to us that we will see more downside. The same technicals that last week indicated to us that we were going to see a sell-off, and that's exactly what we saw. So that's the daily chart. The weekly chart, I want you guys to pay attention to. And this is something that we touched on last week's video. If you guys watched last week's video, you guys will probably remember this. But I do want to give you guys a reminder because this is panning out even more so now than it was last week. What we were talking about is we were talking about this purple line, which is the 50-day simple moving average, coming down and crossing this green and yellow line, which is the 180-day and 200-day simple moving average. In essence, what happens here is when this line crosses, when the simple moving average, the 50 simple moving average crosses the 200 simple moving average, what we see is called a death cross, right? And when this cross happens, which is what we are seeing right now happening right before us, that indicates that we are going into a bigger sell-off in the overall market. And the only other time that we ended up seeing that is, you guessed it, in 2008, right? In 2008, we saw exactly that. So going back to 2008, which was all the way back here, let me go ahead and get that centered for you guys. That is the only other time that we saw the 50-day simple moving average approach and cross, right? After that, we haven't even seen the 50 cross, or we haven't even seen the 50 even get close to the 180-day, 200-day simple moving average, which right now we are literally crossing it. But like I said, the last time that we ever saw this happening was actually in 2008. It was closer to the end of 2008 and then going into 2009 where we started seeing that recovery. But 50-day simple moving average, we ended up seeing the cross right here. The sell-off was already started, kind of like what we've been seeing right now. This was a sell-off that we saw basically that entire year. We ended up seeing selling pressure. As soon as we crossed, boom, market dropped. And then we finally found a floor going into 2009. And then that's when we finally started seeing a recovery. Once we saw that EMA or the SMA, the 50 SMA, which is this purple line, cross back above this 200-day simple moving average, that's called a golden cross. And that indicates that the market will continue to start seeing buying pressure and it's going to start taking off and going up to the upside. So we are currently right here. We are at this cross right here, and that is what's about to happen. Never ever have we ever seen this happen before. I don't know why nobody else is talking about this. I have not seen a single person talking about this technical panning out right now. But if you guys are hearing this for the first time, consider you guys yourselves very, very lucky. And hopefully, you guys understand that, the reason we do technical analysis on a very big time frame, and then we kind of go into a smaller time frame as we, try to analyze more and more, is because when you start out on the big time frame, you will see these big trends, right? Never again, right? Never at all have we even seen that 50 even get close to this 200-day, 180-day simple moving average. It's always been at a very significant distance from crossing, right? Right now, let's go ahead and zoom in. That way you guys can kind of see just how much we are crossing. We're not just close, we are literally crossing. We already crossed the 180-day, which is this green line. We are right over here. The 200 is right here. Once that cross happens, we are very convinced that we're going to start seeing much more selling happening in the market. And that would align with us going into that recession that everybody has been talking about. If you guys haven't thought that we are in a recession yet, this should be a wake-up call for you guys, because we are definitely going into something major. And I'm not saying that I know exactly what's going to trigger it. It could be these new rate hikes that we see next week. We've seen the banks collapsing, right? We see inflation data coming in hotter than expected. We're starting an emergency fund out of thin air, which could only mean one thing, that we're probably printing money, right? Which is only going to make the inflation worse, right? Which is only going to result in us needing to raise rates higher, right? So that's kind of what's happening with the weekly chart. Something very important that you guys should be paying attention to. Again, we're back at the daily chart right here. And we kind of broke down the daily chart when we were looking at that. One thing I do want us to pay attention to on the weekly chart as well, besides the death cross that, is major for you guys to consider, is the fact that we are pretty much in a very similar, position with the RSI as we are on the daily chart. We are sitting at about 49, plenty of room to run to the downside and become oversold, right? So if we sell off to about, let's say, 155, 160, that's when we're going to enter that oversold territory. And that would make sense for us to see a sell-off this big, because if we measure percentage-wise, what we saw in 2008, that's where we would be at if we did drop the same amount of percentage. I'm not saying it's going to happen the same exact way, but just a reference point for you to consider. Again, plenty of room to run on the RSI. At that point, we become oversold. We find support, kind of like we saw in 2008, and then we begin our recovery slowly but surely over the next couple of years. MACD, we are starting to see a convergence, right? We're starting to see this blue line converging with the mean line, which means once we start seeing that selling, we already saw it change from green to purple, which indicates that we are dropping. Not so much a happy face, but a sad face, because we are actually starting to see selling pumping into the market. And so that's kind of the RSI and MACD breakdowns on the weekly chart. Also not looking very, very good. That's one thing I can definitely tell you. And the last chart I want us to look at is the 4-hour chart. And things start kind of looking a little bit better the more you get zoomed in, the closer time frame that you're looking at. And I feel like that's a lot of the reason as to why people miss these bigger trends that are actually happening. And that's because they're so focused on the now. They're so focused on what's going on right now that they don't see the bigger picture. And as a technical analyst, you should be looking at the big picture. You should be looking at the small picture, or the more zoomed in picture. And that's why we try to only go up to 4 hours, because the more you go in on the time frames, the less clear the picture becomes. Obviously, you want to trade on a closer time frame because you want to catch those intraday moves. But as far as analyzing the bigger trends, it's very difficult to analyze those trends, right? So looking at the 4-hour chart, what we are looking at on the 4-hour chart is, again, lower lows, lower highs. We are starting to see just that trend forming of more selling coming in. We are definitely opening up into kind of a megaphone pattern, a descending channel. a descending wedge. And I wouldn't be surprised for us to see, just how far we sell off, right? The one thing I want you guys to know on the 4-hour chart, there's the EMA right here. We closed below the EMA on the 4-hour chart. Again, RSI not so clear as to which direction. Sitting in the middle, 45. We could go up to the upside or we can go down to the downside. If we consider the bigger trend that we are looking at and everything that's going on and the economic data that we're going to be talking about right after this, it would make sense for us to see another leg down, potentially find support right around here, which would be about that 280 level, and then possibly put in new lows, depending on how bad that data comes in. Now, you might say, well, it looks like we are converging on the MACD. Well, guess what? We saw that convergence happening before, didn't pan out. So now we're starting to see that convergence again. If tomorrow does not go very well, we'll probably see more downside. And that's not uncommon. We saw that happen here. We saw that happen here, attempting to converge, didn't converge. Saw that here, saw that here. So it's not very unlikely that it's going to happen. It's actually very possible. So now let's talk about what's happening tomorrow, which is a huge, huge day for the markets. Tomorrow, the CPI data comes in 1 hour before the market opens. So I'm based out of the Pacific Northwest. So our time zone is the Pacific time zone. That means at 5:30 in the morning, we're going to get the CPI data coming out. Let me go ahead and pull that up for you guys. That way you guys have an idea as to what is going on with the CPI data. So 5:30, we have the core CPI month over month coming out. We have CPI year over year coming out for the month of February. CPI coming out month over month for the month of February. And then those are the three biggest reports. In essence, all of these CPI reports, core CPI and just the overall CPI, we have forecasted 0.4% for the month over month, 6% for the year over year on just the CPI. And then for core CPI, 5.5% year over year, and then 0.4, same thing as the CPI for month over month. So we want to see, depending on what position you want to be in, we want to see either, it come in hotter than what's expected or less than what's expected, right? So if any of the numbers come in, I'm going to go ahead and pull this chart up for you guys again. That way we can look at both when we are talking about this data. Let's go ahead and pull up that daily chart. So we're looking at the daily chart. Let's go ahead and pull up the calendar. So if we see the core CPI or the general CPI come in hotter than expected, we will most likely start seeing a sell-off in the market. And the reason being is because inflation is obviously hotter than expected. It's not a good thing for the market, right? And what that usually means is if it's hotter than what's expected, the Fed will most likely be raising rates. And I think with the fact that, they managed the bank situation, the bank collapse situation so well that a lot of people are like, well, they might not raise rates. They might pause everything just because it's hitting the banks, it's hitting the financial sector very hard. But at the end of the day, they don't really care. Obviously, they're not here to destroy the economy, but they have to do their job, right? Part of their job is price stability, right? And so if they would have let those banks, fail and do nothing about it, price stability would not be under control. Obviously, that is one of their duties. One of their major tasks that they need to be doing and focusing on is price stability, right? They don't want inflation out of control. So their goal is to obviously stabilize things. And so in essence, if they didn't do that, things would be a lot more hectic. And so at the end of the day, that is their job, right? And getting inflation under control, no matter the cost, is also part of their job, right? So it's not out of the question that they might raise rates regardless of, this whole bank situation that happened, right? So it might be 25. They might not go as aggressive as they initially thought. Maybe they thought they would go 50, but now with the bank situation, they might go 25, or they might not raise rates at all. We're going to really find out on the 22nd and 23rd. Nobody really knows, how the Fed is going to make their decision, but we do know that we're going to get an answer then. The one thing that I want you guys to prepare, regardless of what happens, is if CPI comes in hotter than expected, there's a bigger probability that we will see rate hikes, and possibly the more aggressive rate hikes that they are considering. So whether that be 25 or 50, there's a bigger probability of us seeing rate hikes. On the other hand, if CPI comes in less than expected, obviously the probability of rate hikes goes down. Maybe the Fed does consider to pause on rate hikes for the month of March, and then kind of reevaluate going forward. But that is really what we're looking at with the CPI data. So huge day tomorrow. Very, very important. And that is what's happening on March 14th. That's Tuesday. And really all of the action is going to be pre-market at 5:30 in the morning Pacific time. Wednesday, we do have a couple more. We have core retail sales month over month for the month of February. That's a big one. We have the PPI report coming out month over month and year over year. And then we also have retail sales month over month coming out on Wednesday. Crude oil, that's more for people trading energy. If you're trading energy, definitely one to pay attention to. And then Thursday, we're looking at building permits for the month of February. That's going to be an important one to pay attention to on Thursday. And then Philly Fed business conditions for the month of March. Not a big one. The manufacturing index is what you guys want to be paying attention to. That's going to be the big one. And then Friday, we don't have anything extremely crazy to report on Friday. So that is the key economic data that you guys should be paying attention to. Hopefully you guys found this video informative. It gives you guys a little more perspective on, where we should expect the market to go. If A happens, we should expect B to happen. If B happens, we should expect C to happen. Lastly, I just want to go over some levels with you guys. To the downside, obviously, we're watching on this short position. We're watching that next level down, which is 261, which again was a support before 3 times over the last couple of months. So definitely a huge level to pay attention to. If we do see CPI come in hotter than expected, the Fed does consider raising more rates. Regardless of 25 or 50, rates are going to be going up. We're definitely going to start seeing selling, and that's what we are anticipating is going to happen. We're going to probably head to 261. So that's going to be our target for the downside. For the upside, our first target is going to be 310, which was that previous support level. And then after that, we're looking at 336 to the upside, which was another previous support level. So those are the 2 levels to the upside if the market does start doing well and start recovering. But what we are anticipating is the market will continue to sell, and we are headed for this 261 level as a first target level for our short position. So hopefully you guys found value in this video. I'll see you guys on next week's Stock Talk video.